Shalom, people. Welcome back to the show. Today we're talking about the hardest part of starting a fund. Now, as you guys know, this channel and our whole thing with Investment Fund Secrets is dedicated to help people launch and scale investment funds. It's been very fun. I've launched 2 funds. I'm actually launching a 3rd fund right now. In the next couple of weeks, it's coming out. We have helped hundreds of other fund managers get started in their fund journey. We have a few student funds that have done well over $10 million, a few that have hit over $100 million, and one that's over $2.5 billion that they've done in and raised AUM inside of their fund, which has been crazy. So in this video, we're going to talk about what is actually the hardest part. I mean, we have over 4,000 students. I've seen a lot of funds. What is the hardest part? Is it the SEC? Is it legal? Is it investors? Is it reporting? No, it's not any of these, okay? These are stuff you might think about, oh, it's going to be hard to figure out. We teach this all the time in our course. We go through all of it. I'm here to tell you the hardest part of starting a fund. Now, I've gone through, in this video, we're going to talk all about it. The last year, I've been a part of or in the thought process of launching around 4 different funds. And all 4 of them, some way, shape, or form, didn't work out because of this one big thing. So you guys ready to get into it? Sound good? So let me paint a scenario for you. I think we've all been there when you're starting a business. Everybody gets together. You got a few guys or gals that you want to work with. We all hop on a Zoom call. Everyone starts chit-chatting about this great idea. Oh my gosh, we're going to do this really cool thing. We make some assignments. Okay, let's meet back next week and we'll talk about it again. Everyone disperses and you come back the next week and no one has done anything. Anybody been a part of this? I've been a part of dozens of not really companies, ideas that were on this track. Everyone leaves, okay, we're going to be focused this week. Let's do it again. Everyone leaves, they come back, nothing is done. And because people are busy, they got kids, someone's going on vacation, we got to wait for this to get done. And what happens is over the course of a month or a week or a year, things fall through. And that the actual company or business does not get launched. So because of this, and now we're going to touch on this. I know I'm teasing the hardest part. I'm gonna tell you guys in just a second, and we're talking about starting a fund today, is the actual forming of the actual who are the partners going to be and what are you going to actually, how's the split going to work underneath that, and how are you actually going to, what are the bylaws of the actual company and who's going to do what. Now, this sounds dumb. You're probably watching like, Bridger, that's so dumb. That's easy. I have been a part of too many businesses, especially funds. This is the biggest thing that blows up. I was on a call this morning. I had a partner call me. We were looking at starting a fund. The 2 partners, I was on a trip over the weekend. I was gone. I get back today. It's Monday morning. The 2 partners decided they hate each other. They don't want to work together anymore. This blows people up. And why did they want it? So let me dive into that. These 2 partners, what happened? Number 1, they got a little greedy on the splits, both of them. Both of them wanted more for what they were doing, didn't feel like they were compensated well with their equity split. And number 2 was this, who's going to do what? One partner didn't think the other partner was doing much. He was wasting his time. And that partner didn't think he knew what he was doing. If you can nail this right at the beginning, it is massive, massive to get launched. Now, the SEC, the reporting, the filing, all that kind of stuff, we can help you with. We have tons of videos, we have a course, we have actually a black card group. We work one-on-one with people to do all that. That stuff's not that hard. The harder piece comes down to this. Who are your partners? What are you going to split? And who's going to do what? So let's dive into a little bit of this. Now, you guys have seen me draw this out before. I call it the 3 circles of a fund.
3 circles of death.
3 circles of whatever you want to call it. 3 circles of a fund is a good name for it, okay? Over here, you have your expert investor. In the middle, you have your fund manager. And over here, you have your money raiser. Every fund, big or small, has these 3 categories. Now, sometimes it's 3 people. Sometimes it's 2 people that split between the 2 of them. Sometimes it's 1 person that does all 3 of those, but all 3 of these roles need to be taken care of. On the left over here, this person is your person that's amazing at trading options, right? They are just sitting in their basement all day. They trade options. They're just incredible, right? This is your expert investor. This person is kind of like me. I'm usually pretty good at this. This is the fund manager. This is the person that understands the SEC, puts it all together, formulates everything, gets the documents, the legal, the reporting, all the operations happening here. And then finally, the money raiser, it's in the name. This person's very good at connecting capital to your fund, going out and going to fancy parties and dinners and meeting all the wealthy people and bringing the money in. Now, I get this question from everybody. Bridger, okay, I get the 3 circles. And by the way, as you grow, you're going to end up doing a slice of one of these 3. But, at the beginning, what should the equity split look like? Because guess what? And this happened this morning with that fund I was a part of. This guy thought that he was better than these 2 guys. And this guy over here thought, oh, no, I'm way more important. I'm bringing in the money. The money's way more important. And this guy right here said, dude, I'm doing all the work. I'm up till midnight running documents. You guys are at fancy parties, raising money. Like, why are you taking more money? And you can see how all three parties don't like to get along. So the question I always get, Bridger, what does equity split up typically look like between these three parties? Now, again, this is like all business. It's all negotiable. So I've seen some funds where this guy gets 20%, this guy gets 30%, and this guy gets 50%, right? Like, I mean, it just doesn't matter, right? Sometimes there's different people for different things, but as a general rule, and I've worked with hundreds of funds, what I have typically seen, even at big funds that have thousands of employees, typically and maybe they have 50 partners, about 1/3 of the equity goes here, about 1/3 of the equity goes here, and about 1/3 of the equity goes here. It's weird that it equals out. I've just seen that. I look, this is the legal ops, CFO partners all get this. Your capital markets partners, you get about 1/3. I've seen your expert investors get about 1/3. I think it's a good baseline to start from, especially when you're trying to formulate a partnership. Now, let me make another note. Sorry, I'm going on a rant here, but this is so crucial. With a fund, something I love to do and I even talked to these partners, say, guys, I think we can figure this out. We are not setting up like Facebook from day one. A lot of people, especially in the fund world, you get a lot of egos, you get a lot of these, freaking alpha male, alpha females that want to just go kill everybody, and they won't take less than their certain equity percentage they believe they should have. Guys, we're not setting up Facebook today. The beautiful thing about funds is we can set up fund one today. This is fund one, and we split our equity, whatever we think. Maybe it's 1/3, 1/3, 1/3. What we can do is fund one will run. Well, guess what? Probably a year from now, we're going to set up fund two with a new partnership, a new entity. And guess what? We can renegotiate our equity splits with a lot more data. Because right when you're starting a business, you really don't know who's going to perform what. And everyone talks the big talk. You really have no idea who's going to do what. By the time, after a year though, you're like, okay, I get that, this person can do this very well or does it very poorly. You then can launch fund three with different partners. If you want to bring in new partners, cool. What I mean is we're not starting Facebook. We're not starting Facebook from day one where you've got to be very careful with what equity you're giving up. In funds, you launch multiple funds. You can renegotiate equity. Now, another thing that I love, Bridger, how do we, what if somebody's bad or whatever? I love, and actually I just did this in a new fund I'm launching right now. We put a clause, as partners, we have 1 year. Okay, we have 1 year in our partnership. After that year, we're all going to sit down together as partners. And this, by the way, this works in some partnerships, won't work in others. But after a year, we can renegotiate our equity splits based on certain KPIs. And actually, one of my mentors' funds, they had about 14 partners on their first fund, which is hard. I mean, you're pulling in a lot of egos, a lot of people. 14 partners is a lot of people. And they had no clue if some would perform, some wouldn't perform, like what's going to be what's going to happen here. And so they said after a year, we're going to renegotiate. You are subject to lose 50% of your equity if you don't hit certain KPIs or performance metrics based on the group decision. Any partner could lose up to 50%. What it did is what it kept everybody accountable. One of my mentors was telling me, he said after that first year, he goes, we had one partner that was just busy, had another business, he had whatever. He just didn't spend much time working with us. He lost 50% of his equity after a year. And then on the next fund, he got a way, way, way smaller percentage on the next fund. And what I was saying before about, back to the title of the video, the hardest part of starting a fund. Again, the partnerships, the roles, who's doing what. And the biggest answer to this in any of my businesses I've started, and again, you guys know my story. In college, I started 6 businesses, right? And now I have multiple 7-figure companies. And the companies that worked and the partnerships that worked and the ones that got off the ground quickly were all built off of momentum. I think momentum is huge and underrated. If you can get your team to the first dollar as quickly as possible, it absolutely changes the trajectory of that partnership, which ends up being the hardest part of the fund. Because that's what everyone at the beginning is motivated. Everyone's like, oh my gosh, coolest idea. We all got momentum, right? Let's get working. But after you go for 3 months or 6 months or 8 months or a year, people go, you know what? I'm going to do something else, or I'm going to move on, or this is taking too long. If you can get people to the first dollar as quickly as possible, because guess what happens? When you start getting $1 from a new business, you go, shoot, frick, maybe I should spend some more money there. The moment your partners all get a distribution, a paycheck, everyone goes, shoot, you know what? I'm going to probably, I've got all these side businesses and real estate and other stuff I'm doing. I'm going to probably spend more time and attention to this thing because I can see the momentum and I already have dollars in my account. I had a mentor tell me this years ago. It was one of the best things I've ever done. I am a big believer in momentum and getting to that dollar quickly. So how do you do that? How do you get to that first dollar quickly? In my opinion, back to those 3 circles, don't be as stringy about the equity. Again, you can launch multiple funds. You can renegotiate later. Get started fast. Number 2, use resource like we're telling you here. We got tons of videos. You guys want to see some of our other videos above. We've got videos on starting hedge funds, how to put them together. And number 3, if you really want to go fast, we have actually a one-on-one coaching group. I've got about 8 coaches on my team. We have a whole fulfillment team. We help you launch funds. We help people launch funds in 3, 4, 5, 7, 10 weeks through the whole process up. Raised $5 million, $7 million, 10, 12, $15 million. It's all about momentum. I pay for shortcuts. If you guys want to work with us, you can click the link below. I think there's like a call link or something you can hop on, see if it works for you guys. But I'm a huge believer in momentum. This is the hardest part of starting a fund, is getting the right team in place, getting the right partnership. And again, this is the hardest part of starting a fund. Once you're running the fund, there's a whole different set of problems. But starting a fund, getting it started, this is the biggest roadblock you'll hit. And if you can get over it and be able to use some of these tools, you'll be in a good spot. Thank you guys so much. Hit the like button below, subscribe. We'll see you guys in the next video. Bye.